Hello, and today we are looking at unit number 2, financial literacy, but we will be looking at section 6, that is page 41 of your textbook. Page 41 of your textbook, and as we have said that we are looking at financial literacy, the first thing that we have to know and understand is the accounting concept. So this is new to you because it's the first time that you do economic and management sciences. Okay, so please listen carefully. We are going through accounting concepts. They say that at the end of this lesson, you must be able to know and understand the accounting concepts. In this lesson, we will learn about basic accounting concepts. Accounting is often called the language of business, okay? And like any other language, it has got its own terminology. So there are definitions that we need to know. You must learn this accounting language and use it effectively in a business environment. These concepts form the basis on which accounting is built. We will discuss the following basic concepts. This is what we will discuss. Number 1, capital. Number 2, assets. Number 3, liabilities. Number 4, income. Number 5, expenditure. Number 6, profit. Number 7, loss. Number 8, budget. Number 9, savings. Number 10, banking. Number 11, financial records. And number 12, transaction. And this will give us the understanding of the accounting language. Okay, remember this is in page 41 of your textbook. Okay, so let's look at the accounting concepts. I need to take this down a little bit. Okay, just up. Yes, now we are good. So let's look at the accounting concepts. The accounting concepts will enable you to better understand the language of accounting. We have already mentioned that we've got the language of accounting. And the financial literacy sections in this study guide and later in grade 8. Okay, these accounting concepts will enable you to better understand the language of accounting and also understand the financial literacy sections in the study guide and later in grade 8 and even grade 9. Okay, if you want to take accounting in the future, you will still use this. Make sure you know and understand a concept before moving on to the next one. So you need to understand this before you go to the next one. Remember, we said there are few terms that we are going to discuss, and capital was the first one. So let's look at capital. You need money to start a business. The money used to start and run a business is called capital. So capital is the money used to start and run a business. Okay, so again I repeat, capital is money used to start and run the business. Capital refers not only to money but also land, buildings and equipment used to produce goods and services. So the money that you use to start a business and the land, buildings and equipment used to produce goods and services, we call that together capital. A person may use their own money to finance a new business, which is called their own capital. So capital is not only money, it's also land and buildings and equipment used to produce goods and services. So if you are asked to define capital, you can say capital is the money used to start and run a business, and also land, buildings and equipment used to produce goods and services. Sometimes, however, a person does not have enough money to start a business. What to do now? Which is often why they often need to borrow capital. So if you don't have capital, you can borrow it. Okay. Borrowed capital may be obtained from banks or other financial institutions. Interest is charged on the borrowed amount, and the person must repay the capital plus the interest to the financial institution over a certain time. So if you borrow money from bank or capital from bank, the bank is going to charge capital. So for example, if I borrow 10,000 rand and the bank charge me the interest of 2,000 rand. So if I borrow 10,000 rand, the bank is going to give me 10,000 rand, but they're going to charge me 12,000 rand as interest. Okay, then it means I need to pay back the bank 12,000 rand. Although they gave me 10,000, but I need to pay back 12,000 rand, of which the 2,000 rand was for interest. But you will know later how to calculate interest. If the people cannot repay the money, their personal belongings will be repossessed and sold to settle their debt. Debt is the money that you owe the bank. Okay, so if you owe the bank the money and you cannot pay it, the bank comes, they take your house, or they take your car, or they take anything that is valuable that you have. They sell it to settle their debt, to pay back the money that you owe them. So you see, you must make sure that when you go and you borrow capital from bank, you are able to pay it back, because if you are not able to pay it back, you might even lose more, your belongings that will be repossessed. Repossessing is when the bank takes your items and sell them to settle their debts. Now, where do we get the capital? Capital has got sources, and the sources of capital are the following. Let me maximize this. Can you see this? Let me do this a little bit. I will take it down so that you see that. Don't want the other paper to distract us. So sources of capitals are savings. Okay, so savings is one source of capital. Okay, inheritance, if your parents or your grandparents, they left you some money when they died, at least you have a capital. Okay, and you can get a capital loans from relatives, which is borrowed capital, and loans from financial institutions like banks, it's borrowed capital. But savings is your own capital, inheritance is your own capital. So when they say sources of capital, it means where can you get money? You can get money from your savings, which is own capital, inheritance, which is own capital, loans from relatives, which is borrowed capital, loans from banks, which is borrowed capital. So there are four sources of capital. Okay, so we are done with capital. We look at the second term in our accounting language, which is assets. These are the valuable things which a business owns and benefits from in generating income, such as machinery and building. So the asset is the valuable items that the business owns and benefits from in generating income. Okay, so for example, machinery and buildings. Different types of assets include fixed assets and current assets and non-current assets. So assets are divided into three types. We have fixed assets, we have current assets, and we have non-current assets. Okay, so let's look into assets in depth now. Okay, can you still see? If you can't, please open your textbook in page 42. Okay, at the top of page 42 there. So we have fixed assets, and they explain fixed assets are for long-term use. This is the key. Fixed assets are for long-term use. The most important fixed assets are land. These are the example of fixed assets: land, buildings, vehicles, okay, and equipment. If I ask you for Examples of fixed assets, you tell me that they are long-term, and examples are land, buildings, vehicles, and equipment. Okay. And current assets, we refer to stock. Okay, the stock or cash that is easily accessible and which constantly flows in and out of the business. So current assets are assets that are easily accessible. For example, stock or cash. Okay, cash is converted into goods and then back into cash. And then we have non-current assets, are not expected to be converted into cash within 12 months. All the assets that can not be converted into cash within 12 months, for example, machinery and equipment, are example of non-current assets. Okay. So fixed assets, they are for long-term use. Examples, land, buildings, vehicle, and equipment. Current assets are assets that are easily accessible and can be converted into cash easily. For example, stock and cash. And non-current assets is those assets that can be converted to cash, that cannot be converted to cash within 12 months. For example, machinery and equipment are non-current assets. Please know the definition of each asset type and the examples. Very important. Now we look at the term number 3 under our accounting concept. It's liabilities. Okay, what are liabilities? Liabilities is any money a business owes to other people or businesses is called liability. So if I'm a business, I owe a bank 10,000 and I owe somebody else 5,000, that is a liability. This debt must be paid back at some stage, and it decreases the wealth of a person or the business. So if I owe somebody 10,000 rand, it means my total wealth is low by 10,000 rand. The net worth of an individual is an indication of his wealth. Okay, net worth, it means how much do you have in terms of cash and assets. This is determined by subtracting the value of their liabilities from the value of their assets. Different types of liabilities include current liabilities and non-current liabilities. Remember, with assets, we've got fixed assets, current assets, and non-current assets. But with liabilities, we only have two types: current liabilities and non-current liabilities. Let's look at each. Current liability, it must be paid back within a year. Current liability must be paid back within a year. So if it's a loan that you took, you must pay it back within a year. The party to whom the money is owed is called the creditor. If I'm a business and I owe you, you are the creditor. Okay. If I'm the business, I owe Macro 10,000 rand. Macro is the creditor. Okay. An example of a current liability is when a business buys stock on credit. You see, if I sell a toothpaste and I stock from Macro, I buy on credit. Macro is my creditor. Okay, and I have a current liability with Macro. Okay, and then we have non-current liabilities. It's the liabilities that may be paid back over a period longer than 12 months. An example of a non-current liability is the mortgage loan. Mortgage loan is what we call a bond. If you purchase a house or you purchase a land, or you purchase a property, we call that a mortgage loan. Normally those loans, they are being paid back in 20 years or 30 years. So those are non-current liabilities. And we have term number 4. Yes, term number 4. The first one, our first term there, it's capital. Second is assets. Number 3 is liabilities. Then number 4 is income. Okay, let's look at income. Okay, let's look at income. What is income? This is the money a business earns from selling goods or providing a service. So if I sell toothpaste, I get an income. Or if I am a hair salon, I style your hair, I provide a service, and the money that I get is an income. Income is the money a business earns from selling goods or providing a service. Individuals may also earn an income from salaries, wages, investment, dividends, rental income, profits, and interest. These are different ways in which people can get an income. Okay. And the next term is expenses. While the main goal of the business is to generate income and make profit, it needs to pay the water and electricity bills and salaries and wages and insurance. These expenses are necessary to run the business. Okay, so these are the expenses that are necessary to run the business. Okay. Individuals also have expenses. We also have expenses, as we need to spend money on goods and services. For example, we must buy groceries, we must pay for water and electricity, school fees, etc., to satisfy our needs and wants. Those are expenses. So the example of expenses that you see for a business, it can be water, electricity bills, salaries, wages, insurance. But for individuals, it can be groceries, water and electricity, school fees, etc. Okay. Then we look at profit or loss. The main goal of a business is to make a profit. Profit is the difference between money received and money paid. A loss occurs when expenditure exceeds income. That is profit or loss. Let's go through profit or loss again. Profit or loss, the main goal of a business is to make a profit. Profit is the difference between money received and money paid. Remember the difference in maths? We said difference has got to do with subtract. So they say a profit is the difference between money received and money paid. So which means that profit is income minus expenses. Whatever is left, it's a profit. If you get a positive answer, it is a profit, and if you get a negative answer, it is a loss. So okay, don't worry about negative and positive for now at your level, but a loss occurs when expenditure exceeds income. So for a profit, income must be bigger than expense. Then you have a profit. But if expense is bigger than income, then you have a loss. Okay? So profit is income minus expense. And how do you see a profit? The income must be bigger than expense. Okay, so for example, if my income is 1,000 rand and my expense is 800 rand, it means my profit is 200. But if my expense is 1,000 rand and my income is 800 rand, it means I have having a loss in the business. Okay, because my expenses exceeds income. Okay, now the term there is budget. Budget, this is an estimate of income and expenditure for a certain period. So for your budget, you plan how much will be my income, let's say for January until December every month. For January, my income will be this much and my expenses will be this much. For February, my income will be this much, my expenses will be this much. So if I do this estimate for a certain period, this is a budget. A good budget will ensure that an individual or household or business or government will have enough money available to satisfy their needs. Okay, so you just make sure that you have money to cover all your needs by planning the budget. This is a very important thing in life. And we have savings now. Savings comprises the portion of a person's disposable income which is not spent. So if you do your budget and your income is 1,000 rand and your expenses is 800, it means you have 200 left. In this 200 left, we call it a disposable income, okay, which is not spent, okay, right? So I can take this savings and I can put it in the account, all right? They say it will be accumulated or invested for use at later stage to convert into wealth. So if you want to be wealthy, you must have savings, which is the disposable income, and you put it aside every month for a certain period of time. It can be 5 years, it can be 10 years, or you invest it, okay? Then you can use it later to convert into wealth. That's how you accumulate wealth. So it's very important that in your budget, you always have disposable income, which is money that is not used or spent, okay? You cannot spend more than what you have. That is a loss. And we are left with 3 terms to look at. We have a banking. They say a bank is a financial institution that uses money deposited by clients for investment or savings, grants, loans, and interest, and changes currency and exchanges currency. It keeps a record of how much money clients deposit or withdraw. A bank charges people a fee for using its services. Each time you deposit cash at the bank charges a cash handling fee. The more money you invest in your bank account, the more interest you will earn on your investment. Okay, so a bank, they use the money that is deposited by people, okay, as savings or investment or interest, and exchange currency. And they also keep record of how much each client has deposited or withdrawn. Okay, so each time you deposit a cash at the bank will charge you a fee. Even when you withdraw, the bank will charge you a fee. And the next is financial records. These are the formal documents which represent transactions. Transactions is when you are taking money out of the business or money is getting into the business. We call that transaction. Any movement of money within the business, either inside the business or outside the business, into the business or out of the business. Okay, these are transactions. So financial records are formal documents which represents the transactions of a business or individual. Financial records includes income, we have discussed it, expenditure, which is expenses statements, tax returns, etc. Keeping financial records organized is the key to running a successful business. So every business must have financial records. And what is a transaction? Transaction, it comprises of any activity where money is involved. All transactions are recorded on a source document. What is a source document? It's a receipt, it's a check counterfoil, it's an invoice, which serve as financial records. So you need to know examples of source documents, which are receipts, check counterfoils, and invoice. And you need to know what is a transaction, any activity where money is involved, either into the business or out of the business. And this brings us to the end of our accounting concepts, and here are the definitions that you need to put in your notes. Okay, please write down this on your notes, and this brings us to the end of lesson number 6. And after the end of lesson number 6, you must do activity number 10 on page 43. Activity number 10 at the bottom of page 43. But you can skip number 1 if you have previously visited the bank, or you can ask your parents, your family, what is there at the bank, and write number 1. You don't have to actually visit if you can't get into the bank, but you can write what you know is in the bank or what your family can tell you. That is number 1 on activity number 10. Then you do number 2 to number 5. Okay, activity number 10, it needs to be in your book, number 1 to number 5. That brings us to the end of lesson number 6 on accounting concepts. Okay, thank you.